Here's something that took me years to admit. I spent a long time building businesses, and almost none of it building wealth. The revenue was real, the exits were decent, and I genuinely believed I was playing the right game. I wasn't. What I didn't understand is that the most important decision you'll ever make as an entrepreneur has nothing to do with what you build. It has everything to do with where it lives. Most people obsess over the business, the product, the margins, the market, and those things matter, but they're the wrong starting point. Because a brilliant business inside the wrong structure is still a limited outcome. There is a version of building businesses where every new one resets the clock. You start from zero. You carry full risk. You pay maximum tax. And everything you build is completely disconnected from everything else. And then there's another version, where one structure owns everything, where profits flow intelligently, where your businesses protect each other instead of competing with each other. The wealthy don't just build businesses, they build what owns the businesses. That structure has a name, and once you understand how it works, you can't unsee it. Think about how most people build wealth through business. Idea, launch, grind, exit, beat. Then do it again. Different product maybe, different market, but the same pattern. Always starting from zero. Now here's what's happening underneath that pattern that nobody talks about. Every separate business you own is its own island, its own legal exposure, its own overhead, its own tax situation. And critically, the profits from one cannot flow into another. The assets in one cannot protect the assets in another. You're building real things, but they can't talk to each other. Now think about what it looks like when someone gets this right from day one. Mark Leonard started Constellation Software in 1995. For 30 years, he's been acquiring small, boring, vertical software companies, payroll tools for dentists, and scheduling systems for auto shops. Individually, every one of these businesses is unremarkable. Together, inside a single holding structure, Constellation is worth over $60 billion. He didn't build more businesses, he built a machine that owns businesses. If you owned 10 rental properties, but each one had separate legal exposure, separate insurance, and no shared equity, is that a portfolio, or is that 10 separate gambles? That's what most entrepreneurs are actually running. They think they're building a portfolio. They're building disconnected risk. The goal was never to start more businesses. The goal was to build a machine that runs businesses for you. If this is already making you rethink how you've been building, hit subscribe. I cover the real mechanics of wealth building every week, and this is exactly the kind of thing most people figure out way too late. So what exactly is a holding company? You've heard of Alphabet, the company that owns Google. Most people think Alphabet is just a rebrand. It isn't. Alphabet is a holding company. It owns Google, DeepMind, and Waymo, all operating independently under one parent that controls capital, manages risk, and makes strategy across the whole portfolio. A holding company owns things. That's the whole idea. Here's the way I think about it. Imagine the general manager of a sports franchise. He doesn't play, he doesn't score, he doesn't practice. But he controls everything that matters: who's on the team, where the money goes, and which players get traded. Without the GM, you have talented individuals running in different directions. With the GM, you have a franchise built to compete for decades. A holding company is the GM. Your businesses are the players. And here's something most people miss. The clean structure, the org chart with a parent and subsidiaries, is actually the least powerful part. What the structure enables underneath is where things get interesting. 1. Asset protection. If one subsidiary gets sued, a bad year, a contract dispute, a disgruntled customer, the lawsuit stays inside that entity. It cannot reach your holding company. It cannot reach your other businesses. It cannot reach your real estate. Think of it as fireproof walls between rooms. One fire doesn't burn the whole house. Without the structure, one bad event can damage everything you've ever built. Inside a holding company, the damage is contained. 2. Tax efficiency. An ordinary business owner running everything personally pays full personal income tax on every dollar of profit the moment it lands. A holding company owner, in most jurisdictions, pays almost nothing at that same moment. The tax code wasn't written against you. It was written for people using the right architecture. 3. Capital deployment. This is where it starts to feel like a weapon. When your profitable subsidiary generates cash, the holding company pools it and redeploys it into an underperforming subsidiary, into a new acquisition, into real estate, without distributing it to shareholders first and triggering a tax event. The money stays inside the structure. It keeps working. LVMH does this constantly. Bernard Arnault moves capital between his 75 luxury brands, using profits from Louis Vuitton to fund emerging ones, to acquire competitors, and to support struggling divisions, all without the capital ever leaving the structure. 4. Acquisition power. And this is the one that fundamentally changes the game. Once you have a holding company, you are not limited to building from zero. You can buy businesses already profitable, already with customers, already with systems. You fold them in and scale without the grind of starting over. This is what Berkshire Hathaway is. Warren Buffett hasn't built a business from scratch in decades. He acquires them. He doesn't start, he owns. Entrepreneurs start, owners acquire. The difference is who controls the game board. That changes the math entirely. Let me show you exactly how. Two people. Both are smart. Both are driven. Both built 3 businesses over 10 years. Person A runs them separately. Every dollar of profit hits his personal tax rate immediately. When he wants to fund business 3 using profits from business 1, he has to distribute the money, pay tax on it, and reinvest whatever's left. He's funding his next business with after-tax dollars every single time. Person B uses a holding structure from day 1. She acquires her 3rd business using untaxed capital from her 2nd. Person A is still saving up for his. Same number of businesses built, same decade, completely different financial outcome. Here's the thing that reframes all of it. The business was never the asset. The structure was. Most people spend years trying to build the best possible business. And that's not wrong, but it's incomplete. A genuinely good business inside the wrong container still leaves most of the value on the table. I know because I did exactly that. People hear holding company, and they think that's for billionaires, for family dynasties, for people with lawyers on retainer and a family office in Geneva. Not for me, not yet. That instinct is understandable, and it's wrong. The holding company structure becomes relevant the moment you have more than one asset, or more than one plan. That's the threshold. Most people watching this are already past it. Because here's the uncomfortable truth. Without structure, you don't own a portfolio, you own a mess. And a mess is much harder to grow, much harder to protect, and much harder to eventually sell. The question isn't whether this applies to you, the question is whether you're building the foundation before you need it or after. Here are 3 questions worth sitting with before you do anything else. First, how many income streams or businesses do you realistically plan to own in the next 5 years? If the answer is more than one, the structural conversation is relevant right now. Not eventually, now. Second, are you comfortable with everything you've built being exposed if any one piece fails? Because without a holding structure, that's the default. One lawsuit, one bad year, one catastrophic decision, and everything outside of it could be in the line of fire. Third, are you building to sell, to grow, or to hold? The answer shapes the structure. Businesses inside a holding company can be sold individually without disrupting the rest of the portfolio. That's not possible when everything is tangled under one roof. Now, here's the timing truth that catches almost everyone. The optimal moment to build the structure is before you need it, not after your 3rd business, not when a lawyer tells you you're overexposed, not when a deal falls through because your ownership structure doesn't make sense to the investor sitting across from you. You don't build the foundation after the house is already standing, you build it first. So everything else can go on top of it properly. Most people don't. And that's where the gap opens up. But here's what the structure actually forces. And this is the part that matters most. There are 2 kinds of people building through business. Operators ask, how do I grow this business? Better product, better team, better revenue. These are good questions, but they're questions about one thing. Owners ask something different. They ask, how do I build something that grows businesses? Not a single business, a system, a structure, an organization that operates above any individual company. Berkshire Hathaway is the clearest example of owner thinking at scale. Warren Buffett doesn't go deep on any one business. He doesn't run operations. He doesn't optimize products. He controls the structure that owns the businesses that do all of that, and he has compounded at roughly 20% annually for 6 decades because of it. That shift from operator thinking to owner thinking is what separates a $5 million outcome from a $500 million outcome. Not the idea, not the market, not even the execution, the structure and the mindset that comes with it. The wealthiest people in the world don't own businesses. They own the structures that own businesses. So here's the question I want you to actually answer. Right now, today, are you an operator or are you building toward being an owner? Because the answer to that question determines everything else. There's a business you're thinking about building right now. Maybe you're already in the middle of it. Maybe it's still an idea you're sitting with. Here's the only question that matters. What structure owns it? And if that business had a catastrophic year, what else would it take down with it? Because starting without asking those questions isn't ambition. It's activity. And activity, no matter how relentlessly you pursue it, is not the same thing as building wealth. You don't build a $500 million outcome by starting the right business. You build it by owning the right structure.